All right, recording on. Today is Wednesday, July 31st, week 4. So as we get started, any questions about anything? Was everybody able to get the file built for that last homework assignment? All right. Well, that's where we're gonna start today. So we're gonna try and do 3 things the next 90 minutes. One, we're gonna talk about finishing off the bull, the bear, the target of of Nvidia. I then want to talk about how we reuse the model, and so we'll do a quick practice of that and let you guys kind of run through a practice valuation in class, and then we'll set up next week's homework assignment, which is we're using the model to do a valuation on another company. Okay. And again, based on the real-time nature of this class and the fact that I'm doing another version for the BUSI 718 class, which is live. I recorded that video last night, and that's actually going to be the video that you're going to watch for this week. So I deleted the videos that were there from like 3 years ago, same thing as last week. And we're going to do just kind of real-time valuations and analysis. So just FYI. So I did edit the assignment for next week. It's got all the data. Costco is going to be your homework assignment. And the data is up there to do Costco with the recent data as of yesterday. So that'll be next week's homework assignment. All right. The other thing I did before we jump started, and I have a question for one of the teams, is I started putting in the data for your group projects. So in the files folder, there is a folder called team data. Each of your teams has a team data folder. So for example, Meta, which reported and beat earnings today, share price was up 5%. Basically, here are all the raw data files you need to do the valuation, as well as part of the EIC. So here's the spread. Here is the what do I call it? Beta, industry beta. It's all the raw data files. The only thing I'm putting in there is some analyst reports, some BICOs. I'll throw those in there. But essentially, you guys can start working on your team projects, which are going to be due in a couple weeks. The question I have is for AstraZeneca. So I assume I know the answer, but I want to check with you. So AstraZeneca actually reports in dollars, but their share price is in pounds. So when you do the valuation, you can do it one of 2 ways. If you do it in dollars, you're going to have to kind of convert to a Great British Pound to get to the accurate share price. Or I have the option, Bloomberg, to export all the data in pounds, even though they report in dollars. It just does a real-time translation and then just give you everything in pounds. So I assume that that might be what you prefer, but I just wanted to double check with the team. Does that question make sense? Give you a better view of this. So if you go to AstraZeneca and, for example, I look at their share price, which is we're going to use off the screen. That's their share price today in pounds. If I go to their historical financials, which I am exporting, these are in dollars. But with one click of the button, I can switch these to pounds. And the model works, doesn't really care about the currency. Might make it a little bit easier if you did everything in pounds. But before I gave you the data, I just wanted to validate you're good with that.
I don't want to speak for my entire team, but I would say that makes sense too.
Yeah, it makes sense, Professor. That'd be fine. Thank you.
Okay. So like I said, you're going to be the only, I'll use the word anomaly, difference between the 4 teams is that all your data that I'm going to give you when I export it is going to be in pounds. Okay, I'll just convert it all when I send it over. So
Got it.
look at
All
your and think you're in dollars because the model, will say dollars, but it doesn't care. But regardless, just recognize you're working in pounds. All right, so I'll put that data up there shortly and you guys can get started. But again, what's going to happen is last week of class, each of you are going to make a PowerPoint presentation of approximately 20 minutes and 5 minutes per section. So you'll have 5 minutes to do the EIC on your company and industry that it's in. You'll have 5 minutes to do the historical analysis, the ROIC tree, the CFI analysis. You'll have approximately 5 minutes to do the valuation, which is the target as is bull bear target and your buy sell hold recommendation. And you'll have 5 minutes approximately to do the multiple analysis, which is what we're going to be covering in class next week. So, and after next week, then we go to our final project week. So as I said, giving you the data to start working on that so that you're ready essentially in a couple of weeks to do that project. All right, so if no other questions or comments, let's jump right in. So let's start out with Nvidia, which is where we left off last week. All right, so just to remind ourselves, what we did is based on last week's share price, which I believe was 122.59 at the time of the valuation. We created a valuation model that essentially matched that. We took raw data from Bloomberg, which created standardized income statements and balance sheets. We then used historical ratios to basically forecast financial statements, which created forecasted economic statements, which create balancing CFIs and free cash flows, which basically turned into the valuation. Valuation tab. Right? And that was the 122.59. Right. And that was a process called the as is. And the goal of the as is essentially to say if a company's worth the sum of its future cash flows, then these are the cash flows that lead to that price. Right. So we kind of know the price, we're backing in the cash flows that approximately lead to that price. Okay. And there's some key drivers that were most important when we do this. Obviously, we can change anything, but driving free cash flow, these three numbers off the ratios, right? Trying to get a good revenue growth rate, EBITDA, margin, and tax rate that's realistic. We also tried to get a good perpetuity value, particularly for perpetuity EBIT margin, which we got off of the trading multiples. And we use the consensus estimates for the margins. And that essentially helped us get an ROIC. And then our last step was to estimate a G that kind of got us to that current share price using goal C. So that's kind of a process for doing the as is. Today, what we're going to do is we're going to do 3 more files. So we start out with the as is, which is the value of the company today. And then what we're going to do is we're going to create 3 more Excel models called the bull, the bear, and the target. And generally it helps to do an EIC before you do this, which is why that was one of your assignments. You kind of know what's going on at the industry level. But the general idea is to say, okay, we're eventually going to do a target share price, which is what do I think Nvidia's share price is going to be within the next 12 months, right? Based on intrinsic value. And then the question then becomes, okay, how high could it go in a reasonable good case scenario? That's called our bull. and how low could it go in the next 12 months in a bear scenario. And we're going to have those two models as well. And then somewhere between the two is our target. And then the difference between the target and the current share price creates the buy sell hold. Okay? That's kind of how you get to a buy sell hold opinion. So again, if you think about if you took any class in finance that had portfolio theory, one of the key points you learn in portfolio theory is diversification. And to be a diversified portfolio, you need standard deviation. So it's price against standard deviation. And in a way, that's where we are going to do the bull and the bear, because the bull and the bear kind of help the funds start to understand, if the sell siders are selling their research, what could that standard deviation look like? And not only how wide a range could it be, but it doesn't have to be a symmetrical range. Could it be more upside or downside? And that will help them with their allocations beyond just here's my target price for a company. So we're going to kind of include that in this class as part of the assignments. So take our as is valuation, and we're going to start with the bull. Okay. So file, save. 758. And so I'm going to change this to say, instead of Nvidia as is, I'm going to call this the Nvidia bull, file number 2. All right. So the question then becomes, and you guys kind of help with the EIC, what could reasonably go better for Nvidia that could lead in the next 12 months, that could lead to an even higher share price? Meaning what sort of industry level things or competitive things could be even better than the current forecast? What would you say? So, Yang?
I guess the demand for AI just ramps up and it may affect the G, perhaps.
So they get even more revenue growth because AI is even bigger. Matter of fact, here's a data point for the Meta team, when Facebook/Meta reported their earnings today. One of the things that Zuckerberg was talking about is they're going to spend even more in AI because it's starting to be successful, and they actually beat their revenue guidance, and they attributed some of that to AI. So it's almost like self-fulfilling. And that's good for companies like Nvidia. In fact, the share price is up 10% today, mainly because both Microsoft and Meta have been talking about spending even more on AI. So that could be translated to potentially higher G as well as potentially higher growth. What else, Craig?
Could lower their WACC somehow.
Okay, so you could make an argument that they would be less risky going forward. Although generally, when you do a DCF valuation, one of the assumptions the book talks about is we tend to use a target capital structure, which means that we leave the WACC alone. Right? Now, if you really believe that the Bloomberg WACC is not representative of the long-term WACC, obviously you're welcome to change anything. But I guess the question would be, from your perspective, what would drive the WACC lower?
Economies of scale and oof,
But that would be an unanticipated that we didn't see
yeah.
when we think about risk. So it could be, but generally we don't try to change the WACC too much. Greg, what would you add?
Interest rates. If interest rates start to change, will that affect cost of capital?
Okay, so we can make an argument that the WACC might be lower in a lower interest rate scenario. So we can put that into our bull slightly. What else could go into our bull scenario? Anything else from your EIC, 5 forces, competitive advantage?
I mean, some of the competitors go down, like they become the only supplier.
So you're talking about the competitive advantage?
Yeah, I mean, they have competition in the market, so other competitors may go down, like there's a bug in other chips, so they don't work anymore, and Nvidia suddenly becomes the only supplier.
So basically their competitive advantage stays strong and potentially gets even stronger and they get even more dominant in their position. Just kind of translating. Okay, so let's model a few of these out. So one of the things we could do, we'll start here with the ratios. And in the bull scenario, the other thing to consider is tax rate. So one of the things is that the corporate tax rate from the Trump tax cuts expires next year. And depending on who wins the election, there's an argument about what can happen to tax rates as well. Okay, the Republicans want to, right now it's 21%. They're actually saying if they win their election, they want to get to go to 18. And if the Democrats win the election, they said they're going to let it expire and the corporate tax rate goes back to 28. So that would also play out in the bull bear scenario. So in the bullish scenario, tax rates stay low and they're already at 17%. So I'm not sure I would make them lower, but basically that might be part of our bull scenarios, keeping the tax rate at 17%. Now, very important that when you're doing your write-up and your presentations, that you not only talk about the numbers you're going to change, but why you're changing them. Okay, that's just very important. So being very clear about your assumptions. So even if I'm leaving the tax rate alone, I'm explaining why I'm leaving the tax rate alone. Right. The other question is, if they are growing faster, then this is year 6, the beginning of the perpetuity period. Okay, they're already growing 17%. And that year isn't going to matter as much. In fact, remember, if we look at our DCF valuation, it's the operating value, which is the majority of the value of any company, all right? For Nvidia, it's 90 something percent because they're worth 3 trillion at the time, and 2.99 trillion is operating value. And any single year does not have a big effect. The majority of the value of the 3 trillion is not in the first 5 years. That's 284 billion. It's the 2.7 trillion of value in perpetuity. So again, those 4 numbers are really critical. And for many companies, they're going to be this way. 70 to 90% of their value is going to be the continuing value. So less worried about the perpetuity 1 year 6 growth. The real growth rate is going to be here, which is our long-term growth rate. Right. Now, remember, we're dealing with compounding. Right. They're already growing in perpetuity at 10.7% a year forever. So got to be careful because, for example, if I were to go to 12%, that would get me a share price of almost $200. And that would get me to a valuation approaching 5 trillion. Now, I'm not saying that this couldn't happen, but you just got to remember, you're talking about compounding here when you're talking about these perpetuity values. I'm already compounding a pretty high number. So realistically, if I took what you guys said and said, all right, they're going to grow faster, maintain their advantage for longer, because AI is going to be even bigger, I might go not to 13 or 12 from 10.7. I might go to something like 11 to 0.5%. Okay. By the way, when I do that, my share price jumps to 142. Right. And another assumption we could make is the EBITDA margin. Now, right now, in perpetuity, multiples are suggesting 65%, right? Which is near the high end of the range. And then they start heading back down before this perpetuity number. So the point is, maybe they maintain their competitive advantage longer, which means slightly higher margins for a long period of time. And this is already near the top of their range. So I don't think it's going to go that much higher, but let's call it, 66. Okay. So slightly higher EBITDA margin. Okay. Which gets me to this growth rate doesn't matter as much. Maintain the tax rate, slightly higher G. I don't think that spending in the balance sheet is going to go down much further, and they're going to get more economies of scale because we're already kind of seeing some of that, right? And historically, they're spending more than this. So I think that is the bullish scenario. So I'm kind of leaving the balance sheet alone. And as I said, that gets me as high as 142 in the next 12 months. All right, and I'm going to call that my bull scenario. So that's kind of like the top of my range. Everybody with me? So maybe call that almost 20% upside. Right, things go right. Now, then what I'm going to do is I'm going to create my bear. Okay. Now I'm going to put on not my rose colored glasses, but my deep dark sunglasses and close this file. And it's usually helpful to go back to your as is. So I'm going back to my as is, which I will share again. File, save as, Nvidia bear. Now, starting with my as is, all right, what could go wrong in the next 12 months, right? What are some of the things that might not go to as planned, right? Well, one of the things is, you can kind of see it here, is look how much revenue they have to grow and look how much margin they have, EBITDA they have to generate to get to this margin. Like, let's just say that things take longer. I mean, in a way, we kind of saw that with Tesla. You know, the challenge with Tesla is that as we were transitioning to electric vehicles, you know, a few years ago, the view was it was going to be much bigger market, much faster, and Tesla more dominant. And we've realized that that might have been too aggressive. Well, maybe that plays out with AI, right? So what if these companies like Meta and Google and it's Alphabet essentially, and Amazon and Microsoft, which are half of Nvidia's revenue, what if they start slowing down some of the spending? You know, unlike what they said today, but in a year or two. And
They say.
Alexa, stop.
Yeah.
Sorry, Amazon picked up the word I must have said. And so long story short, maybe the growth rate isn't as high. So it's at 10.7%. Maybe it's 9% a year in the long term, because the transition to AI takes a little longer. There's some data center limitations given energy, and also the companies are not monetizing as fast as they expect. So maybe they cut back on some of the billions. Not to say it doesn't grow, just not nearly as fast. And maybe some of the substitutes start coming into play. Maybe the on-device stuff does become more relevant. And that's an area where Nvidia does not really play. If you're doing it actually on the phone, for example, or a local PC. So then I also think that in a bear scenario, this operating margin could return EBITDA, not necessarily to where they were in 24, but it could get closer to where the 2029 is. So instead of 67%, it's to 60, because competition does show up in a much stronger way, and they don't maintain the market share they do, and their pricing power isn't nearly as strong. And let's say that tax rates do go back up, so that starting in 2026, we go back up to 28%. And so I'm not saying that Meta, which is a global company, is going to pay 28%, but instead of 17, maybe it goes to 22. Well, when we put those scenarios in, share price could go as low as 70. Okay. So I'm going to say that, and that is going to be my bear scenario. So what I'm basically saying is, on the low end, Nvidia could trade as low as 70, and on the high end is Nvidia could trade as high as 144. That's kind of establishing my range with my bull and my bear. And most importantly, because you're going to have to write 500-word papers next week about this, why? Okay, why did I make those changes? And I connect every change to a number that I did. And I'll pause. Make sense? Questions so far? All right. Once we've established our bull and our bear, then we do the final piece, which is our target. Now I give my opinion. Okay. What do I think is realistically going to happen to Nvidia? But I'll tell you, my opinion needs to be between the bull and the bear. Right. I can't have an opinion outside that range, because I've already said the top of the range is this, the bottom of the range is that. My opinion has to be within that range. Okay. Now, again, the easiest way I find to do this is to, again, go back to the as is. So let me close this file and back to Excel. Start again with the as is. Now, what you could say, all right, I think it's a cop out, but what you could say is that the market got 100% right. So the current is my target, okay? And I think from a grading purpose, I would say you're probably copying out and I penalize you for that. But nonetheless, you could say that in the real world. But the question is then why, right? And so what do you think is realistic to happen, right? So I'll throw in my opinion. Where I actually think is going to happen to Nvidia is, yeah, the stock price might go up short term as it did today, although not to past 144. But I actually think that it's going to be great, but maybe not as great. So maybe by 2030, that 1 year growth rate might be closer to 14%. The margins come down to maybe 65. And the G is not 10.7, but it's 10. Okay, so they don't get the growth as much as expected. Kind of like Tesla, eventually both competition slows it and the market doesn't expand as rapidly. Some of their other businesses don't seem to matter that much in terms of the size of the company. And as a result, with slightly lower growth, slightly less margins, and again, I don't think the tax rate is going to go up. Actually, despite who wins the election, I think they will actually maintain the tax rates, despite what the Democrats are saying. And so for those reasons, I think that their value today is closer to 95, but my answer is still sell. So if in your target, you're within 10% of the current stock price to either direction, that's called a hold. If it's more than 10% below that, it's called a sell. And if it's more than 10% above that, it's called a buy. So if this is my target and my price is 95, 10% of 122 is about 12.26. So I'm more than $12.26 below that for my model. Hence, this would be a sell for the reasons that I gave.
Right. And we did not see your target Excel, Professor, if you were sharing
Oh,
it.
was I not sharing all of that as I was talking? I apologize. Sorry. What I had changed. Undo, undo, undo. All right. What I first changed was I said in 2030, revenue growth as it starts to slow, changed to 14%. I then said EBITDA margin went to 65. As the competition had some inroads, not as much as in the bear, but more so than today's expected. I also said that the G long-term is closer to 10. So slightly lower long-term growth trajectory, just market takes a little longer to achieve. And that led me to a share price of 95, which puts me into the sell range. And that is actually my view on Nvidia, meaning I'm glad Nvidia popped today. I think it could have some short-term gains, but long-term, I am personally concerned about, I think there's more downside than upside. And the point is, they almost have to be perfect, meaning you saw the numbers in the forecast, and those are aggressive numbers for anybody to achieve. And if they come in anything below that, then this is what's going to happen to their share price. That's exactly what happened to Tesla, by the way. Okay. Is that if you went back to sort of showing the class last night, and then I'll get to your question, Greg, in a second. My point is, see it here. If you look at Tesla and you look at their share price over the last 5 years, in this period of time, it's kind of where Nvidia is. Early innings, dominant, growing player, their share price got as high as 400. All right, today it's half where it was 3 years ago, 2 years ago, right? And in a way, this is what I worry could happen to Nvidia. And it's not that Tesla is not going to grow and be a dominant, great company. The problem is that it had extraordinarily lofty expectations, and turns out that maybe it was a little unrealistic, right? And I just worry the same thing could be happening to Nvidia. Now, you don't have to agree with that. You could have a different opinion because we're talking about the future, but that's why that's my target. And by the way, if you look at the analysts today for Nvidia, some of them actually have targets above my bull that we just put together. Like here's a 150 from Citi yesterday. Morgan Stanley's at 144. BNP is at 120, 175, 180. Oh, by the way, down here, bunch of people think 60s and 80s, 50s. Right. Ironically, most of these are the Chinese banks. So the Chinese banks are kind of bearish in general on Nvidia. There's a political reason for that. But regardless, if you look at where most of the people are, here's 200. There's some very bullish people. But I'm just telling you, we start to put a DCF that says, what is it going to take to get 200? Those numbers get really, really big. So again, everybody's got their opinion, but regardless, this is what you're going to have to come up with. Sorry, Greg, I was ignoring you for a couple minutes.
I guess my question was, given we're talking about chips and the chips / semiconductor market,
Yes.
how do you equate like I guess you could say the political tensions around that, and how like China's relationship with the US and Taiwan kind of can very seriously play into supply and demand for that?
Well, and I think that's why we do bear scenarios. So we didn't even talk about that. And I think it's a great call out because, you know, political tensions in the world could erect further barriers or worse to what happens to semiconductors and Nvidia, which could stunt a lot of this growth. You know, you already see the US have told Nvidia there's export controls on what they can send to China. And, you know, when you start getting these tit for tat things, it can get kind of ugly. So you're right. That's actually something reasonably we should have talked about and modeled out in our bear. But that's why we put bulls and bears together. Because we want to think about, you know, there's three types of risks. All right. There's the known knowns. All right. There's the known unknowns, and there's the unknown unknowns. Right. You can't really model the unknown unknowns because by definition, they're unknowable. But the known unknowns, like that's what the bull and the bear is really about. And so I think the political risk was a good miss that we didn't get to, and we could put it in there. Because obviously it will affect revenue, it'll affect margin, it'll affect growth. Other questions about this? All right, so from now forward in your assignments, you're turning in 4 Excel models and you're turning in a minimum 500-word paper explaining the changes that you are making and why. And it's very important to connect the dots, okay? I'm making this change because of this reason. Okay, that's what needs to be in your papers and eventually in your group presentation. Now, to practice this process, I'm going to do this showing you how to use the updated model. All right, so it took us a couple hours to build the first file and do all this. It's going to take us 10 minutes to do another company. Okay, now I'm not saying we're doing it well, but at least mechanically from a process standpoint. So here's what we're going to do. I put in the files folder. Sorry, wrong share. In the files folder, under a subfolder called week 4, these 3 subfolders. Okay. One's called target, which is the retailer target, which is what we're about to do. One is called in class, which is a example I'm going to put you into Teams in just a few minutes and let you do. That's where the data is going to be. And then the third folder is Costco, which is next week's homework assignment. Okay. Data's here, but I also put links to all the data that's here into the assignment website. So back to this. So what I'm going to do is we're going to use the target data here. Okay. And just because it's going to be easier, I'm going to share my desktop rather than jumping back and forth because I'm going to be jumping around a lot. All right. So share Zoom. Share desktop. All right. So once again, I'm going to start with this Zoom menu out of the way. I'm going to start with the Nvidia as is. Okay. Oh, shoot, file. That was my target. So we go back to the as is. All right, this is the Nvidia as is. So file, save as, and this is now going to become TGT, ticker symbol, target as is. So it still has the Nvidia data, but I'm now going to use this to value target. Okay. So what I need to do is the data to reuse it is going to be from this tab called model data. This is the 6 years of historical of data that's coming from Bloomberg, income statement and balance sheet for any company that we value in this class. So this is put it. This is the data I'd uploaded. This is called target data file that I'm going to give you. Okay, so this is the data exported from Bloomberg that has 6 years of historical data for target, not Nvidia. So what's going to happen is you're going to select this whole tab in the target data file. If you want to follow along, you're welcome to play at home. You're going to copy this. You're going to go back to the what used to be the Nvidia model, first tab. You're going to select the whole tab, right click, paste special values. All right. I don't want to copy and paste because if you copy and paste, Excel might create a link to that other file. And every time you open it, it's like, where's that other file? Problems will occur. So we're going to copy data across spreadsheets, paste special values, just put the numbers in. But it's got to go row for row, cell for cell, otherwise it's going to break the model. So therefore, take the whole tab, copy it, take the whole tab, put it in. So now this file has the target data. Okay. First step, the last reported year is 2024. It's the last historical year because they reported in February. So technically targets in fiscal 25. Starting with the assumptions. Last reported year, make sure it matches. It's already 2024. Operating cash as a percentage of revenue. We're leaving it at 2% this semester, just in the compressed nature of the class. 2% of revenue represents 1 week of cash. If you want to make it higher, you're welcome to, but there's no company out there that's going to operate on less than 1 week of cash. So that's where the 2% assumption comes in. Next, I need targets WACC. So back to the screenshots. I'll give you a screenshot, TGT WACC. This was their WACC as of yesterday, 9.1%. So I'm going to take the WACC and enter in the target WACC of 9.1%. Next, I'm eventually going to solve for a G. So I'm going to put 3% as a placeholder. Right? I need their shares outstanding. That is going to come from the DES screenshot. It's called description in Bloomberg. Okay. You're going to get 2 data points from here. One is the share price. So they were at 147.90. I think it was 97. I don't know why I got cut off. 47.97. And then you're also going to get for the DES screenshot the share count. Down here, current shares outstanding, 462.6 million. So 462.6. Okay. And then from the earnings estimates, I'm going to get the forecasted revenue and the forecasted EBITDA and start transposing. So 2025 revenue, 105,894. So 5,894. 2026 revenue, 109,936. Not growing nearly as fast as Nvidia. For 2027, 113,898. And for 2028, year 4, 118,057. For EBITDA, 86,58. 2026 EBITDA is 92.71. (2027) 96.87. And the forecast consensus 10.065. Now we are forecasting a 2029 and the screenshot cuts off after year 4. So in the folder, I will give you something called EEO2. And what I've done is I've just literally moved it over one column so you can get that extra year here of 2029. So the 5th year revenue forecast, 122,349. And for EBITDA, 10,614. And then for the trading multiples off the EEO, we will use forward years 2 and 3. So EV to revenue 0.77 and 0.74. And EV to EBIT for 2nd year is 13.12. And it was 12.43. That number. So the trading multiple suggests their EBIT margin somewhere between 5.9 and 6% in perpetuity. Ratios. This is Nvidia's tax rate. I now need Target's tax rate. That's going to show up in a screenshot called guidance, GUID, right? Now, Target doesn't have one. For example, Walmart has a file called guidance. So if a company gives guidance on what their tax rate is going to be, it'll be here in the guidance file. And they're suggesting 25.5% is their kind of out year guidance for tax rate. So we're going to use their company's guidance of 25.5%. Okay. Now, remember that if we made any changes, these are Nvidia's numbers. So for example, Target's perpetuity EBITDA margin is not going to be 67.5%. Okay. That was Nvidia's because I was using the Nvidia data. So I need a more realistic EBITDA margin. So we know from perpetuity that these multiples suggest 5 to 9 to 6 is what this number needs to be. So to make this number 6, this needs to be 8.6. 26%. Okay. And then if I assume the balance sheet's not going to change, and I've made these kind of key changes, that out year about 3% seems reasonable, then last step, estimated G. So data versus tools. Okay, from tools, goal seek. So what I want to do is I want to set my share price to be calculated to the current share price, which is 147.97, by changing G. And so have the B7G keep iterating. Excel just iterate until this model says 147.97. So the answer would be 6.52%. So that is an estimate of Target's G at that ROIC that leads to the 147.97 share price. That is targets as is. And that is the process to do that. Yes.
What
Steven?
did you do with the years 2029 and 2030? Because that messed up my model.
For which one?
Um,
Talk about here?
in the assumptions, yeah.
Well, the one is, this is off of EEO2, not off EEO, because EEO
Okay,
only gives you the first four.
gotcha.
What
Okay,
I had to do is I had to go over one column and take another screenshot, and I call that EEO2.
got it.
You'll grab that off of here.
Okay,
And then down here, though, we're still using forward year 2 and forward year 3, which will get off of EEO, EV to revenue, EV to EBIT for perpetuity.
got it.
These were the first two clean. This is the first clean forecasted years. So 2 clean forecasted years. Good question. Other questions? All right, last step. If you're in the situation where we are with Target, right, and we don't have a tax rate, right, what do? Right? Alternative is the analysts are actually trying to do the same thing we're doing, sell side analysts. So we have access to JP Morgan. So I will give you a JP Morgan analyst report. And the reason I give you JP Morgan is JP Morgan's analyst reports always include a little bit of their model, and they're forecasting the tax rate. So this is the analyst report. I could do a search for tax rate. And actually, it's not this one. Oh, Walmart. This is in Target. There we go. Target. Tax rate. So this is where they're forecasting Target's tax rate. Try and make it a little bit bigger. Start right here. And generally in the forecast period, which is going to be these years, 22.7, 22, 22, 22, 22, 2, 22. So I'm going to use 22. Okay. Because I think that the JP Morgan analyst is doing a reasonable forecast of what the tax rate's going to be in the real world. And so they're using essentially 22. So even though the company's not giving guidance, the analysts still have to figure this out. To make our lives a little easier, we're going to kind of copy the homework of the JP Morgan analyst. So in this case, 22, which I should have done before I solved for the growth, because now my share price is going to be a little off. So back to goal seek, tools, goal seek, set the share price again to the current share price, which was what, 147.97. I'm changing the G. So actually my G is going to be 6.1%. So we know that somewhere around 6% growth and 14% ROIC incrementally is what the market's expecting today for Target long-term based on the share price. That's the as is. We then do a bull, we then do a bear, we then do a target of Target. More details actually on the video. We did this in longer, took longer last night, 3.5 hours. We only have an hour here, hour and a half here. But nonetheless, this is how you do the as is and reuse the model. Questions? All right, time to practice. So in the files folder, in week 4, there's a folder called in class. It's got the data for Walmart. So what I'm going to do is I'm going to break you into teams. I'm going to give you 30 minutes. And I'm going to ask each of you in teams to do the full valuation of Walmart. Create the 4 files, the as is, the bull, the bear, the target. And during our last 10 minutes of class, I'm gonna call in a couple of the teams to walk us through what you did. And why. It's a dry run for your next week's homework assignment. So here is breakout rooms. We got, I'll put you into 4 teams of 3 or 4. I'll give you 30 minutes to work on this. And unless there's any questions. All right, use one of the models that you guys created for Nvidia. All right, go. All right, welcome back. Which team wants to kick us off and show us your as is?
We can do that if it's okay.
Great. Go ahead and share the screen.
All right.
All right, so kind of just quickly walk us through.
So, we plugged in the numbers as is, and then for the target price, we goal seek said that the CV, the growth is still 4.95. That's what it led to.
All right, what'd you use for a tax rate?
Tax rate is 25.5%. We took the guidance.
Okay, and looks reasonable. Did everybody get that G around 5%? The teams?
No, we got 4.53%, but I also see that our EBITDA for 2030 is different. Not sure how much that plays a role.
So that was off of assumptions. Go back to the assumptions tab. Somewhere between 4.6, 4.8 based on the trading multiples.
Oh, okay, I see.
Make sure you're actually making the EBITDA, not that number, but that plus the depreciation. So the depreciation needs to be 6.6 to get to the 4.8 operating income. Common mistake you might have made. All right, just in the interest of time, hopefully everybody got an as is. It looks like this. This looks pretty good. So why don't you walk me through your bull and your bear?
So do you want to show us the bull and bear as well? Okay. So this is bull. We thought the growth rate would be 5.5 because there are other revenue streams that are being in place: healthcare, automation and grocery delivery. They're partnering with Amazon, expanding internationally. So all that goes well. So they would see a growth rate of 5.5. That brings us to us. But we think the perpetual growth rate would be 5.2, not 5.5. So that will give their model price to 94.
So your operating income is higher or lower in perpetuity?
Our operating income, we have not.
Did you change your EBITDA margin? M7?
Yes.
Up or down?
We upped it up.
Okay.
Yeah.
So why did you up that as well?
Yes.
That was a question. Why did you up the EBITDA margin?
Oh, because the increase in revenue from different work streams is going to increase the after-tax revenue for them.
Well, just because you increase the revenue, you don't necessarily increase your margin. So what's leading to higher margin?
We looked in the report for Walmart. It kind of mentioned how their supply chain and everything was pretty efficient. So we just kind of assumed that would actually continue, if not improve, as they grew, and that would allow us to have a slightly higher margin there.
Yeah.
Right, so leveraging the economies of scale or something along
Yes.
it to Walmart. Okay. What about the tax rate in your bull scenario?
We didn't touch the tax rate at all. We just kept it 25.5, consistent across.
Okay. So again, what's important, and I think you're doing a good job, but that's why I'm just clarifying for everybody else. Make sure that when you change an assumption, you're explaining why in each of the changes. Or if you're leaving something alone, why are you leaving it alone? Some of the major ones. All right, so that got you to 94. What was your bear?
Okay, the bear scenarios. Okay. We thought the play, it won't play that well for them, but still they would not lose a lot. Their growth would be 4.5%. Unless lose competitive advantage against target, they may have adverse market conditions because others are catching up. The new initiatives don't pan out that well. The other chains, Sam's Club, not doing well. Maybe there's political instability which hinders their growth or their their expansion routes into other countries. So 4.5 would be their growth rate, and we changed their EBITDA to be lower because it's going to hurt their operating margin if they're not able to go that much. So it's going to be 4.5%, which is like 5.66, 5.2 would be there.
So
Right.
just in your last comment, I know you said it's hard to predict the margin, but if you are predicting it to be lower, you still got to give a rationale for it. Very important to do as you're changing the assumptions.
Right.
So related to loss of competitive advantage, increased competition, supply chain issues, whatever, but you got to have a rationale as you go through these assumptions.
Right. Grab over here.
Okay. So back to, and Sam, okay. And then Target. So right now you have more upside than downside in Walmart. Where did you think they're going to end up?
Yeah. So they may not get huge success, but they would still grow a little bit better than what has been in as a state. So we put their growth rate as 5.05%. With some partial success, since they are big store, though others may catch up the competition, but they still would increase their footprint. So they would get economies of scale, and their other line of revenue would also be. So we increased their position to 5%, which led to a share price of 75.76, which is about 9%.
Okay, so that would be a.
It's not more than 10%, so it's kind of a sell for us.
So that'll be called a hold.
Yeah.
So you
Yeah.
Okay. All right. Overall, I think that's the process that we're looking for. So good kicking us off. Thank you. Why don't we have one other team kind of walk through? We got the as is. Why don't you walk through your bull bear target? Which other team wants to go through that? How about the team with Craig, Mitchell, Steven?
Sure. I got it. I'll share screen. Let me see here. All right. So can you see this?
Yes.
All right. So let me see if I can. There we go. So we started running out of time because we were trying to figure out the as is. So the one thing we did differently from the other group was oh, this is the bear. Let me get the bull.
Looks like you didn't get through the bear.
So for our bull case, we actually lowered the tax rate to 18% because we assumed that we were leaning towards Republicans winning the White House. So ours was based on political environment, and that changed our model price to $90.32. And that was the only thing we changed for the bull case.
So just the tax rate. You didn't change the growth, the margins.
We did not change.
We changed the EBITDA on that as well. We actually increased it. We thought economies of scale. So we increased it to 7.5.
Okay. Versus where it was in the as is.
Correct.
Oh, that's right. Thank you. And then for our bear case,
It looks like you didn't have time to get through that, you said?
we changed the tax rate to 28%, assuming a Democrat would get into the White House. So
Which, independent of all this, notice why taxes are important to companies, because it does really affect the valuations.
Yeah.
So in terms of this, what was the holdup on the as is, or why did it take you guys a little bit longer?
We just had some issues with the numbers, and we figured out what we were doing wrong. It was I don't actually remember specifically, but we were just like missing one thing, and we went through all of the Bloomberg.
We
information.
looked at the wrong plan year or the wrong fiscal year for one
That's
of the
right.
numbers.
Yeah,
And
that's what it was.
Well, I
Yeah.
just want to check with everybody, just, did anybody else have issues you want to ask about with the as is or any of the models?
I have a separate question after.
Okay, Jim Lee,
I think the goal seek couldn't find a solution with the prior one. So we
Yeah.
changed the initial guess to like 2, and then it was able to find the solution.
so two answers. One, sometimes Excel, is Excel, doesn't always work. You might even have to do it manually. But remember the point of goal seek is you start with a guess and then it iterates from your guess. So that's why I usually set that G back to like 3% as a starting point, because it might stop before it gets to the answer. But regardless, because it's supposed to go through like 100,000 times, so shouldn't have that problem. But every now and then, like I said, you might have to do it manually or change your guess. Or sometimes it'll give you a weird number that doesn't make any sense. Then you have to kind of adjust accordingly. All right, so I know we're kind of out of time, running low. Yeah, go ahead. Jen, you had your hand up again.
Yeah. Quick question: how come the operating cash percentage of revenue was kept at 2?
Again, you're welcome to change it. 2% of revenue means a week of cash. So basically, it's the minimum amount of cash you need to run the business. And I think every business needs at least a week. If you really believe it's higher, you could always raise it.
So where do you get that number? And
Well,
how is it intuitively a week of cash?
well, I'm just telling you, there's no company ever that will have less than 1 week of cash on hand of that scale that won't file for bankruptcy. So you won't make payroll. I mean, it's just things like that. You got day-to-day operations. So two things happen in the real world. One, you'll just ask a treasurer, CFO, they'll know. You just say, hey, what do you need for your operating cash? Like when I was a CFO, I knew we needed about 30 days. And so we could never take any more than 30 days out of cash out of our business to do anything else. And so companies know, and the analysts will get a sense for that, talking to the companies, or you just gotta look at what people keeping cash on hand in the industry. You can do some regression analysis on it, etc. It's a whole chapter in the book on this. But for our purposes, we're just gonna keep it simple in our short class at 2%. But if you want to play with it, you're welcome to do that in your models. So again, I'm cutting this short. In the video for this week that you're going to watch, we spent more time on this debriefing this yesterday. So feel free to look at that if you have any other questions. But you're going to be doing this for Costco. You can use your study buddies on this one. If you do, make sure you say who you're turning it in with. But make sure you also, in the papers that you're going to turn in, write up your assumptions. So it's really clear why you're changing what you're changing and make it a business reason for that in the real world. I gave you an analyst report and an industry report for Costco to kind of help with that. But regardless, this is a kind of a dry run. And by the way, AstraZeneca, your team data is now there as well. Put that in while you guys were working. So all of the data that you need to do these models on the companies that you selected for your teams are also there. So you're welcome this week to start working with your teams to get that ready. All right, so somebody had a question that she said was not related.
Oh, I'll look at the videos. I think it'll answer my question.
All right, well, if it doesn't, let me know as well.
Will do.
All right, thanks, guys. See you next week.
Thank you.
Thank you.
Thank you, Professor.